Today, we're going beyond the basics. We're going to deconstruct the reality of global index funds, expose their blind spots, and show why, for certain ambitious investors, taking a more active, intentional approach to individual stocks could be a superior path to building significant wealth. Let's start with the name itself. Global index funds. It sounds all-encompassing, doesn't it? As if you own a piece of every major market and opportunity across the planet. But when you truly dig in, the reality is far more concentrated. When you look at global index funds commonly available like the MSCI ACWI or the FTSE Global All Cap Index, they cover approximately 47 countries. While this is certainly broad, it is far from every investable market on Earth. But the concentration runs even deeper. Most widely used global indices are market capitalization weighted. This means countries with larger total stock market values get a disproportionately higher weighting in the index. The result? Your global fund is heavily skewed. For instance, as of late 2024, the United States market typically accounts for a staggering 60 to 70% of a global index like the MSCI ACWI. Other large developed markets like Japan, the UK, and Canada make up significant but much smaller proportions, whereas a company like Nvidia accounts for 4.5% of that index. What is the implication for an investor? If you believe the next wave of significant outperformance will come from a specific smaller company or overlooked markets, a broad global index fund might severely dilute that exposure. It prevents you from truly capturing that focused return above the market average. Beyond geographic concentration, there's another hidden layer often overlooked: regulatory and governance disparity. While your ETF might be regulated in a highly robust financial center like Europe, USA, or the UK, which offers strong investor protection for the fund itself, the underlying companies it invests in operate under the vastly different laws and corporate governance standards of their home countries. What does this mean for you? If a significant portion of your global index fund is invested in companies from jurisdictions with weaker legal recourse, less transparent accounting standards, or less robust shareholder protection laws, you're indirectly exposed to those risks. This isn't about fear-mongering, it's about control. When you pick individual stocks, you make a conscious decision about the specific regulatory environment and corporate governance you're comfortable with. You can research particular management team and legal framework of that company in that country. In a global index fund, the level of granular control and scrutiny is simply not possible. While they're marketed as purely passive, many large index funds, especially those tracking broad or international indices, aren't as hands-off as you might imagine. For very broad indices, especially those with thousands of constituents or less liquid stocks, such as many global or all-cap indices, fund managers often use what's called representative sampling rather than full replication. What this means is the fund manager actively selects a subset of stocks from that index that they believe will accurately track the index's performance. They don't buy every single stock in the exact proportion. The implication? This introduces a subtle layer of active decision making you might not be aware of, and it can lead to a tracking error, where your fund's performance subtly deviates from the index. You are in essence relying on the active choices in what to include or exclude, despite the passive label. Indices are not static. They regularly rebalance, adding or removing companies or adjusting weightings, typically on a pre-announced schedule. When a company is added to a popular index, all index funds tracking it are forced to buy it, often driving up its price temporarily. The reverse happens when a company is removed, leading to the forced selling. The sheer size and growing influence of passive investing means trillions of dollars flow to index-weighted companies. This can create a herd effect. As money floods into indices, it disproportionately flows into the largest, already highly valued companies. This can exacerbate asset bubbles in those companies or sectors, potentially disconnecting prices from underlying fundamentals. For the investor, this provides an opportunity. An individual stock picker, free from index constraints, can deliberately seek out undervalued companies or smaller companies with high growth potential, not yet included in major indices. Or they can diversify into major companies across industry verticals. So if global isn't truly global, what's the alternative for the ambitious investor? It's about deliberate individual stock selection or highly focused active strategy, allowing you to reclaim control and aim for higher growth. For many, getting the average return from a broad market index fund is a fantastic goal, but for people like myself, matching the average isn't enough. We're looking for returns that outpace the market by making informed, active choices, not just passively accepting what the index delivers. Picking individual stocks or highly focused thematic ETFs allows you to target specific countries or regions that you've deeply researched and believe offer superior growth. Concentrate your capital into your highest conviction ideas rather than diluting it across thousands of stocks where any one company's stellar performance has a negligible impact on your overall return. Embracing emerging themes or sectors directly. Investing in companies that are driving the next big trends before they become mega caps that dominate indices. Avoid overvalued areas or sectors that you deem overpriced, even if they're heavily weighted in current indices. As an individual stock picker, you have the agility to research deeply, develop high conviction in a handful of companies, and allocate significant capital to those ideas. If you're right, your portfolio can see far higher growth than the slow, steady grind of a broadly diversified index. You can enter and exit positions based on your evolving research and thesis, unbound by the constraints of an index. Now let's be crystal clear, this approach is not for everyone. Higher potential growth always comes with higher risk and volatility. Individual stocks can fall significantly, and concentrated portfolios will see more dramatic swings than a broadly diversified index fund. This journey requires a specific mindset and commitment from the investor. Deep research commitment. It demands extensive fundamental analysis, understanding financial statements, competitive advantages, industry trends, and management teams. You become the active manager. Emotional discipline. The ability to withstand significant drawdowns without panicking or making irrational decisions is paramount. Investing in individual stocks is as much about psychology as it is about analysis. A long-term horizon. Just like index funds, even with high growth individual stock investing, success is a marathon, not a sprint. Give your carefully selected investments the time they need to mature and compound. Intelligent diversification. Even when picking individual stocks, intelligent diversification across different industries, geographies, and company sizes within your own universe is crucial to mitigate company specific risk. You're building your own global index tailored to your convictions. So while global index funds offer simplicity and broad exposure, for the investor looking for that next level of growth and willing to embrace higher risk, it's crucial to understand the subtle limitations of what global truly means in the index world. This understanding can empower you to strategically pick individual stocks or more focused funds that genuinely align with your higher growth ambitions and provide you with greater control over your financial destiny. Are you ready to truly globalize your portfolio on your own terms, or perhaps refine your existing strategy with these insights? What are your thoughts on moving beyond broad global indexes? Let me know in the comments.